Hello everyone, today's video is all about income tax planning. So it's that time of year when tax returns are due and tax payments are also due. So just a reminder, 31st of January is the deadline for the balance to pay on your 1920 income tax bill. Not only that, but it's also the time that you pay the first installment of the 1920/21 tax year income tax bill. So it's a bit of a double whammy. Is the 31st of January. Pay the balance of last year plus the first half of this year. So what can you do to mitigate the income tax bill? Well, here's an idea which involves investing a few quid into tax efficient vehicles. Now, during the pandemic, basically, economists believe there has been millions, if not many billions of pounds saved by UK households. So assuming you are fortunate enough to have saved a few quid during the last 9 months or so, and you're looking to spend it, yes, the economists are all saying a lot of consumption will happen and the economy will take off next year. People will spend all this saved up cash. But if you are looking to invest some of that with an eye on tax planning as well, then have a think about a vehicle which is known as a venture capital trust, or VCT. So venture capital trusts have been in for about 25 years, and they are to encourage people to invest in non-FTSE 100 businesses, so smaller size companies, typically with an asset size of about 20 million as opposed to many billion. So the quid pro quo that the government do to encourage people to invest in these smaller companies is to say, look, you invest in these, we'll give you some tax reliefs. We'll knock a few quid off your tax bill. Specifically, 30% comes off your income tax bill for the investment. So let's say you were to invest £10,000 in one of these VCT companies. HMRC say, okay, 30% of that, £3,000, you can knock off your tax bill. So timely right now, when you're having to work out how much tax you owe HMRC in January, if you were to make an investment now or in the early 2021, then the tax bill that you have to pay, write a check for at the end of January, could be reduced. So 30% income tax credit on the amount of the investment. You have to hang on to the investment for 5 years. It's one of the rules. If you choose to cash in the investment, those shares within 5 years, then HMRC will claw back that upfront income tax relief. But assuming you hold out for 5 years and then you sell your shares in these types of companies, hopefully you've made a capital gain at the back end as well. So if the share price has increased and you've made a few quid on a gain, that gain is free of capital gains tax, which is a very good thing. So normally regular stocks and shares, when you sell them, subject to capital gains tax. So these venture capital trust shares, no CGT at the back end. Many of them will also pay dividends. So assuming you have that 5-year holding period, you will receive dividends from the companies every 6 months or every year perhaps. Those dividends are also free of tax, no income tax on the dividends. So again, unlike ordinary dividends from ordinary shares where you would put them on your tax return, you pay income tax on the dividend income, dividends from venture capital trusts are free of income tax. So great upfront income tax relief, particularly timely right now when many people have a big income tax bill coming up. No capital gains tax at the back end and tax-free dividend income for the duration of the investment. So also, in terms of from an investment risk point of view, what makes these particularly attractive to taxpayers is that you are not investing in a particular company, but a basket of companies. So not just one company, but many. And now what tends to happen is that you invest in a business which is listed on the stock market, which in turn invests in a whole series of smaller companies. So that mitigates the investment risk, brings it right down. So you haven't got all your eggs in one basket. Famous examples of companies, household name companies that had some VCT funding at various stages in their existence are Zoopla, Secret Escapes, and Love Film. At one point or another, in the early stages of their existence, they had some VCT funding. So these are open to any taxpayers. It's don't get confused with venture capital. This is venture capital trusts, slightly different. Basically, anyone can invest in one of these VCTs. The where you can get them from, there's a number of providers in the UK, not that many, and you can see all their track record and see how they've got on over the years. Obviously, that's no indication of future performance, but at least it might give you some sort of comfort. But limited number of firms that offer these, but they offer them all the time throughout the year. And higher rate taxpayers, like I said, have used them for 25 years, and they are good at reducing the tax. So do have a think about VCTs, venture capital trusts. If you have got a few quid that you've managed to save during the pandemic and you've got a big tax bill coming up, you can make an investment in one of these and reduce your tax bill. So that's just an overview on VCTs. If you like this video, please subscribe here, and I will see you soon.